today we are asking what the fuck is inflation to
Let's bring in Lauren Goodwin, economist and chief market strategist.
Let's ask Lauren Goodwin of New York Life Investments.
Lauren Goodwin of New York Life Investments.
No one knows inflation is already here better than women. To answer your question, inflation is people probably do need to save a little differently than they have before. People probably do need to invest a little bit differently than they have before.
What causes inflation rates to change and rise?
I was going to ask who controls inflation, but that does answer the question.
This is nerd. There's a real turning point happening in the global economy right now that makes conversations like the one we're having today so important. Don't panic.
We don't understand. Please help us.
Okay, we're ready. I got a lifetime of knowledge.
Let me call Mimi.
Okie dokie. Okay, welcome to season 2 of Actual Experts. Or do we know if
I know
this is
because
gonna
we
be
are
first?
recording exactly. Yeah, we're recording this in December. This is our second to last recording of 2025, but whoever's listening is hearing this in 2026. So happy new year.
Yes. So, welcome to Actual Experts. I'm Caitlin,
And I'm Lundie.
and we do not have all the answers, so we are going to ask the questions.
And today we are asking what the fuck is inflation and the Fed to actual expert Lauren Goodwin, who is chief market strategist at New York Life Investments. Very lucky to have her because what the fuck is inflation in the Fed? I would love to know.
Truly, what the fuck? It was so funny when I was doing the research for this because I was reading it all and I'm like, so much of this is new to me. I think having someone explain this to you is one of those topics where rarely would you try and do the research yourself, and it is so much nicer to have someone explain it.
Yeah, and just also one of those things that you hear about your entire life, of course, inflation, the Fed being the like figurative people,
say?
person, company, organization that like determines what the
knows?
dollar. I actually have talk about the blind leading the blind. Like I
Yeah.
do not know what the Fed does, who makes decisions there, and how it impacts not only the US economy, the global economy, but in many ways the US economy dictates the global economy. I
Totally.
think.
And also, like, the one of my questions is, I assume every single country has their own version of the Fed. Like, we refer to the Fed, which is the American Federal Reserve Bank. I think we'll find out. But I assume every other country has one. But I would like to know.
Okay, so first thing I've learned today is that the Fed refers to the Federal Reserve Bank. Is that what we're referring to?
I think so. I actually don't know. I think that's right.
Okay, perfect. Well, that's good to know. This is very timely also with this week specifically that we're recording still in December because it just came out. I saw this on Instagram, my source of all news. That here in South Africa, the South African rand, our currency here, has strengthened to the best it's been in almost 3 years after it says Fed cuts interest rates. The rand
Well, there you
strengthened
go.
to 61, yeah, against the dollar late on Wednesday night after the US Federal Reserve, parentheses, the Fed, so you are correct, cut its interest rate by 1/4 percentage point. So there's only one rate. And they decided to cut it,
I
and
don't
that
know.
then therefore influenced here in South Africa the rand positively. So the rand has actually strengthened against
Well,
the
great.
dollar. So like, how does it happen? Who decides? Yeah, it's so
All the
figurative.
questions.
It's one of those,
Yeah.
yeah.
Yeah. That we just float
And it would
around
be
in.
great to be able to, yeah, understand how it works. So
I
thank
know.
goodness for actual experts like Lauren.
Exactly. And she's very cool. I know her through the Milk and Young Leaders Circle, which I'm in, which we were also in with Anna Goodwin, who did our What the Fuck is VC episode. And she's so
Yes.
cool. And if we have time, I really want to ask Lauren. It came up when I was at a dinner with her in New York that she grew up on a ranch in Texas and ended up being essentially the chief economist for New York Life Investments. So such an interesting transition. So I would love for her to give us a little spiel on that if we have time, because it's such an unexpected background.
Yeah, and how does one become a chief market strategist? What does that
Totally.
mean? And yeah, how did she get into that and why is she interested in that? I would love to know as well.
Totally.
Um,
Totally. Okay,
all
cool. I
right.
want to give us our fun facts, which also like fun facts and inflation is just a hilarious phrase to put together, but we're going in.
Some,
Okay.
some actual stats, facts and
Actual
figures as we
stats. Okay. So this is interesting. Lundie just spoke about the Fed changing inflation rates, but inflation is intentional. It is not a mistake. So I think sometimes we hear things that inflation sounds bad because things become more expensive. So central banks aim for inflation to usually be around 2% because a little inflation keeps people spending and businesses investing. Zero inflation or deflation is actually worse and often signals an unhealthy economy. What does that mean? I don't
Okay.
know. But interesting that it's actually something that governments aim for. So every single year they want inflation to go up around 2%, which I guess is
Okay.
why people always say, "Oh, my salary hasn't adjusted appropriately for inflation." And that makes sense because things become more expensive. So 2% more every year. And if your salary doesn't go up 2%, then you're not matching the market.
You're not keeping up. Okay, that's interesting. Yeah, I think if you're lucky enough to work somewhere where you typically get a increase every year,
Mhm.
I think standard it's usually around 10% a year. So that means you're far and away above a typical
Who's to say?
inflation rate, I guess. But that's not the case everywhere.
No. And I feel like Lauren will get into this. If inflation goes up too much and things become too expensive, then people stop buying and then the economy slows down. So I think it's like a balancing act of it has to go up to like keep people earning and spending, but not too much because then it's too expensive.
Okay. My next question is like what's the difference between an inflation rate and a interest rate? But I'm sure we'll find out
That's a
how those are
great
related.
question. Yes. Okay. So this one actually we learned a little bit during our investment episode, but cash quietly loses value every year. So if inflation is at 3% and you have $100 in cash and that 3% inflation happens, it then only becomes worth $97 in real buying power the next year.
Okay. Yeah, that makes sense. So
Even
you've
if the
lost
number
3% of value.
exactly because everything is 3% more expensive, so that your $100 don't get you as far.
Yeah, even
So
if you are still holding $100, you can only buy $97 worth of things the following year.
exactly.
Okay.
Yeah, so even if the number in your bank account doesn't change, that's why money can feel like it's disappearing even when you're saving, which is
Got it.
such a bummer, which is why you need to invest, which we learned from Cam Rogers, because you
Right.
need your money to grow more than inflation rate.
Right. Okay. Yeah,
Okay.
I'm with you.
Okay. Last one is the Fed doesn't actually set most this is to your question. The Fed doesn't actually set most interest rates. So the Federal Reserve only directly controls a singular, very short-term rate. Mortgage rates, car loans, and credit cards are set by markets reacting to the expectations of inflation, growth, and what the Fed might do. So, to your point about the Rand, about expecting what the Fed might do or that they change interest rate, the Rand strengthened as a reaction to that.
So the South African Reserve Bank, this is all speculation, thought
Yes.
that the US Federal Reserve Bank was going to increase its inflation rates and therefore that's where
Couldn't,
and then
yeah, you've
the
lost me
rand
there.
swing it. Yeah.
Yeah, I'm
It's
gone.
like
And
yeah.
and that's it. I'm reading you my
It's
fun facts and that's all I can give you guys. Fun
and
fact.
then enter our actual expert who can explain like yeah, I'm really
Literally
curious what
everything.
the relationship between those rates. And then you mentioned mortgages. We did go
Yeah,
back to our episode on mortgage
exactly.
rates. Those are set by the market in expectation of what the Fed will do. But
Exactly.
I mean, who knows what that means?
Literally help.
Really
We
help us. Thank
like
you. Okay. Okay.
over to that.
Yeah, Laura.
Yeah, as we start. Okay, so who is Lauren? Lauren Goodwin is an economist and the chief market strategist at New York Life Investments. She leads the firm's global market strategy team and is responsible for economic and market research, asset allocations, and thought leadership to empower investment decision making. Lauren has a unique ability to explain complex economic and market issues, thank you so much, in a relatable and actionable way. She regularly represents the firm as a keynote speaker at conferences and in television and media outlets such as Bloomberg, CNBC, the New York Times, and the Wall Street Journal. What a beast.
Obsessed. Yeah,
Yeah,
what a beast. And I can't wait to learn from her. Thank goodness for actual experts like Lauren. Let's
exactly.
bring her on.
Woohoo!
Please note that this pod is for educational purposes only. Nothing we say should be taken as financial, legal, or medical advice. Please do your own research, and when in doubt, ask an actual expert.
To tell Lauren, it's so funny.
Hi, Lauren. Nice to meet you. So nice to meet you. I've heard such great things. But I was just explaining after this, it's almost the evening in Cape Town. So I've been invited to a Merry Spritzmas Secret Santa party. It's all girls. The theme is Aperol Spritz. And the Secret Santa is Naughty Santa themed.
That sounds so fun. What did you get?
So you have to bring a gift that you wouldn't want your mom to open. And I don't know if I can say on this podcast what I brought.
Depends on your mom, I guess.
That's true too.
Totally depends on your mom, and we might have to bleep this out, but I went today to a sex shop and I bought poppers
Oh my God.
because I was
that's
like,
hilarious.
that's honey.
That's so fun.
So that's after this. So nice to meet you.
This would be so easy for my incredibly lovely, perfect Catholic mother.
Yeah. Yay. Well, thanks
was
for
so
joining
funny.
us
So-
on that very joyful opening on 8 a.m. on a Monday morning. Poppers. And welcome to Actual Experts.
What are we experts in? More than one thing, usually.
Exactly.
It sounds like it, as most women are. But
Yes.
we just recorded our intro where Caitlin and I talk about what little we may know about the topic. And just wait till you hear it. Caitlin and I are literally like, bleep, bleep, like, what is the economy? Like,
We failed.
who knows?
We
So
failed.
we're very excited to learn from you today.
Yeah. It'll be
Well,
good.
thank you for having me. The obviously like listeners won't be able to see, and actually neither can you, but I'm wearing this sweater that a colleague got me when I in my last promotion cycle, and it says whatever it takes, because you might think it's because I do whatever it takes, but that's not it. It's because I have a cutout of my favorite central banker in my office. And he is famous for saying that the European Central Bank would do whatever it takes to save the euro. So is that the best gift ever? I think it's the best gift ever.
We love it.
Wait, what we need to add here now is a picture of your favorite central banker cardboard cutout in your office. I would love to know
Who
what
is
he or
it?
she looks like.
It's Mario Draghi.
Okay.
And he looks like an Italian man in his 60s, maybe 70s now.
I also think I saw
Please
when I
do.
was doing the research for this that you're like a day in a life with Lauren, and I think you presented. You're like, this is my favorite.
Dude,
central
I blow
banker.
it.
Yeah,
I blow a kiss to him at the end of the day.
exactly.
Which just goes to show how central this garbage is to my life.
I love it. Yeah. Okay, Lauren, I'm going to give you a bit of a rundown on how this will go. Thank you so much for joining us. So, just a bit of context in advance. The way we run each of these podcasts is Lundie and I divide and conquer in a way. One of us always does all the research and comes up with the questions, and then the other one comes in blind from the point of the listener. So, I did the research for this, but I told Lundie in our intro, as I was doing the research, I very much was like, I still don't understand. And so, we're very excited to have you on. And I had to also give context to Lundie. So we are both in this Milk and Young Leaders circle together. And at the conference this year, Lauren, I'd always be like, where is Lauren? So I have someone to sit next to at lunch. And I would just like find her around the conference.
It was
You
mutual.
gotta have those. Yeah, you gotta have those people at those things. So makes sense.
But yes, we're super excited to have you on board. So there are so many buzzwords around inflation, interest rates, all of the craziness. Lundie and I don't understand any of them. So we're just going to dive in and we want to ask, what the fuck is inflation? Please help us.
Well, I do just want to say that in some ways, being able to ask the question, what the fuck is inflation? Like inflation, interest rates, etc., they're so ubiquitous in like daily life and the economy that the fact that you couldn't define it, honestly, even as a professional economist, I have to sit there and be like, okay, how, like, what are the, correct words from a textbook to define inflation? It's just there. Like, it's a part of life.
Yeah.
Um, to answer your question, inflation is the rate at which the general price level of goods and services in an economy rises. So it's tracked by measuring the prices of everyday items. We're talking food, we're talking gas, we're talking cars, new or used, we're talking clothes, we're talking insurance, we're talking your cell phone bill, housing, whether you rent or you own, you name it. So all the stuff that you sort of use in your day-to-day life, how are the prices of those things moving? And that's measured usually in an index. So somebody makes a guesstimate that you spend, X percent of your income on housing. And so the index should have that percent in it, more or less. So it's not perfect. In fact, it's far from perfect. But that's what inflation is. And you'll notice maybe that I said inflation's the rate at which price level goes up. And that's really important because prices, there's this thing going on now where the inflation rate in many economies, including Canada and the US, I actually don't know about South Africa. We'll keep it to Canada and the US, Europe. Rate is back to reasonable-ish levels, but it doesn't feel that way. And there's two reasons for that. One is that the inflation rate is still higher in cities than in other parts of most countries. And the other is that because the inflation rate was so high for so long, price levels are really high. And so even if the rate of inflation isn't going higher, what you pay for, the sort of classic examples are a carton of eggs or a gallon of milk. Those things are still just so much higher than they were just a couple of years ago. And so the sticker shock is still there for people, even if the inflation rate is actually, again, back closer to normal levels.
Okay, I have a few questions in there to break that down. So one, it sounds like, and I'm going to explain this back and you let me know if I've totally got this wrong, but when you're saying that it's so expensive, was there a period of time a few years ago where things just jumped and usually that's what triggers more expensive, but there was some kind of big jump that happened? Is that correct?
That's correct. And that period is the pandemic.
Oh, okay.
So in 2021, 2022, the inflation rate in the United States was almost 10%.
What?
And just to give you a sense of what that means, typically central banks target 2%. So 10% is way higher than that. But maybe to put it into even more context, there's some quantitative research that suggests that when inflation is between -1% and 2%, you don't notice. So you think about you're in the grocery store and you're buying a can of beans and it was $1 last year and it's $1.02 this year. That's still $1. You know what I mean? You don't notice. But when you get to a rate of even 3 or 4%, you start to feel that on an aggregate basis in your daily life. Your grocery bill starts to feel like, wait a second, what happened?
Yeah.
So 10% is big.
Totally. And that was going to be my question is you said at a reasonable rate. So a reasonable rate sounds like 2%.
That's right.
Okay. Very interesting. Go ahead, Lundie.
Can I jump in with a question just to COVID? Was that due to, and we'll probably get into what influences and what causes inflation rates to change and rise, was that due primarily just to the complete unknown and the fact that no one knew what was going on, and so someone panicked and then increased? Yeah, lots of questions around how the
someone panicked.
Someone decided we got to get it up.
Should we go there actually? Why inflation happened? Because actually it's probably not because someone panicked. Although I am still panicking. That was an intense.
Aren't we all panicking?
It's a intense couple of years.
Yeah. Let's do it.
Panicked.
There are two types of inflation, two ways that inflation makes its way into the economy. And I have to tell you, of all, economics is often referred to as the dismal science, because economists are all doom and gloom, myself included, you're always looking for the risks. But this is one of the things that the field of economics got right. They called these two factors that cause inflation things that make perfect sense. So two types of inflation: demand pull inflation and cost push inflation. So demand pull inflation is when demand is strong, in fact, stronger than the supply for something. And so that results in an increase in price. So if you are selling bonbon candy, the Swedish candy, and you're like, it's candy, it costs, a dollar a pound. It doesn't. It costs like $1,000 a pound, but whatever. Let's say
Yeah.
like $10 a pound.
Yeah.
And then everyone in Brooklyn rushes to your store all of a sudden. You're like, oh, like I don't have enough candy. And so if we're speaking in pure economics terms, not like price gouging terms, pure economics terms, you're like, okay, I have 100 pieces of candy and there are 50 of you that each want 10 pieces of candy, then I'm going to increase my price until each of you only want 2. So 50 people, 2 pieces of candy, everyone gets what they want, and I get the maximum amount of money that I can get from you for that thing, right?
Makes
so
sense.
demand pull inflation. And if we go back to the pandemic period, just to sort of like item number 1A, that was happening in a big way in a lot of countries, but especially in the US. So you had a situation where demand for certain things, like going to restaurants where people typically would spend at least some of their money, you couldn't do it. Right. So instead of doing that, you might have spent your money on, I need a desk for my home office because I'm suddenly working at home, which wasn't the case before, et cetera. So goods, especially for the home, like furniture, that type of stuff, we all needed it. And there was only so much furniture available in that moment, right? So that's a really good example of demand pull inflation. And the reason it was worse, I'm putting that in air quotes, worse, it was a stronger impact in the United States, is because the US consumer also received stimulus checks. So not only did they have a need for that desk for their home office, but those making under a certain amount of income or who had lost their jobs also had several hundred to even a couple of thousand extra dollars so that they could buy that thing.
Right. Okay. That makes total sense. Helpful.
So the second type of inflation is cost push inflation. And it's, again, this is like the only 2 terms in economics where you're like, I know, like I can picture it.
Yes.
So cost push inflation is when your costs push inflation higher. So that could be your raw materials. So if you are a jeweler and the price of gold has doubled over the last year or 2, which is almost the case, then you can't sell your jewelry for the same price anymore, probably, right? You need to increase your prices for your customers. This also is very true for the most important input for most businesses, which is labor. And so if your employees are saying like, I won't work unless I make, X% more, and they really won't, and you really can't find someone else, then your costs are higher. And that means that you might need to increase the prices at your restaurant or whatever the case may be. And here too, if you think about the pandemic, that was happening everywhere because, folks were sick, people retired early, there were shifting worker preferences. Like for a long time, some people just like really didn't want to work in restaurants or other areas where they might be exposed to COVID, you name it. And so those labor disruptions pushed wages higher. And then at the same time, you had supply chain disruptions. And so the inputs for many goods prices went higher. So you just had like item after item after item after item, costs going higher. And if you look at the global economy now, that's gotten a lot better. But now you have like casual trade wars, which are disrupting supply chains and changing the way people think about not just how do I get, my input from wherever I'm getting it, Malaysia, South Africa, but also like, do I know I'm going to get it? Do I need to pay a lawyer to make sure that I understand the contracts I'm signing? Do I, there are just more uncertainty. So that panicking question that you asked, Lundie, it does come in, but it's usually not the root cause of why prices are moving higher.
Understood. So helpful. And I feel like that was like a really illustrative example. So that was a really helpful way to like start off. It also answered one of my earlier questions from the intro. Does someone somewhere figuratively decide the inflation rate? And it sounds like someone does not. The economy does. And so it's consumers effectively and all the many, many things that go on with economics that influence that rate. So it's not the Fed that decides it, is what I'm hearing. Is that true?
We've made,
Really starting off with the hard-hitting
yeah.
questions here.
Well,
So I want to just say one thing, like introduce I don't know how I would call it, like an inequality element of what you're describing, Lundie, because you're totally right. It's not like one person or a central bank that sets inflation. It is the economy.
Yeah.
But that is a series of people, right? Making decisions. And there are absolutely businesses that are making decisions like, you know, prices have gone up across the entire economy over the last 4 or 5 years in most countries. And my costs haven't gone up, but other people's have, and I just think I can charge more. Right? It's not always only about your input costs. Sometimes if there's a like zeitgeist around prices moving higher, or if your community can accept that higher price, you're just like, yeah, okay. We see this a lot for luxury goods or just, goods that are designed for consumers that have a little more income or maybe have made investment income over the last few years as the stock market's done whatever, right? So I just want to make that point that there are going to be some businesses that are able to raise prices just cause, and some that maybe won't. So that might be a little harder for a grocery store to pull off if their community is not able to bear those higher prices.
Totally.
So it's a series of decisions that are made across the whole economy for everything.
Makes
that
sense.
is interesting because I was going to ask who controls inflation, but that does answer the question. It's the economy, but then it sounds like a small handful of people also have a role to play in what that looks like.
So the central bank is a really important part of this inflation question because they do have, let's call it influence, but not power. Like the central bank can't sit there and say, no price gouging on eggs. It's not their role. Now, the federal government could, I guess. Depends on, the sort of political backdrop and whether that would be tenable. But the central bank can't do that. What the central bank does is they influence inflation by having one tool, which is their policy interest rate. So this is where you start to use like terms that nobody cares about, to be honest. But if you think about the way that money moves through the economy, there is a cost of money. It's the interest rate. That's the price of money in the real economy. And that's a tool that the central bank actually does manage. And so as we think about, let's think about like how this actually works. Let's say I want that table or that desk for my office, and it costs $1,000, just to use a round number. I hope it's a really nice desk. Let's say it costs $1,000.
It's one of the electric ones that go up and down.
Yeah, exactly. It's a standing desk. Yes. But I only have $500, let's say. And I need to borrow $500 to finance the desk, or I use one of the programs that many retailers have where you can pay it off over time, let's say.
Yeah.
If I'm borrowing money to buy that desk and the cost of that money is higher, so let's say you have to get a 10% interest rate, then that desk is, let's call it $1,050 because I took a loan on the extra $500. Eventually, if your interest rate is high enough, you won't buy the thing because the cost of the money to buy it is so high. Totally. And I've been using an example of a customer, but if you think about it on the business level, you are often borrowing money to bring goods in so that you can make something or sell something, and then you are paying it back. And so the cost of money that the central bank sets, it influences that demand side of inflation because it essentially increased the cost of things that you don't have cash available for.
Right.
If it's not incredibly clear by how like sort of circular this feels, that's a very, what we call in the biz, a very blunt instrument.
Yeah.
Like, again, the central bank can't say don't increase prices on that. And they can't say maybe don't buy that fancy thing because it's pushing prices higher. And they can't say like, could you use the not standing desk? Like, could you just get like a less expensive desk? They can't do that, right? And so all they can do is make it more expensive for you, whoever you is. Yeah. And so to say that they control inflation is true, but it's indirect.
Okay, I have a few questions on that. One, just for people just for the listeners out there, what is a central bank?
Great question. A central bank is a bank for banks. Every country has one,
Okay.
and they do a few different things. Basically, they make sure that the financial system runs smoothly.
In that
They
country.
set
In
in
the
that country.
Okay. Okay.
So for the US, for example, it's the Federal Reserve. We have the Bank of Canada, the Bank of England, the European Central Bank, same job, different style. And each of these central banks, they're in charge of bank supervision. So they set the rules by which the banks sort of do and do not do their business. They provide financial services to those banks and to governments. They can be a custodian of their cash, for example. Like it's literally a bank for other banks, including the government.
And do they lend to each other? Like if Bank of Canada is like, ooh, I need to buy timber. Well, actually, no, that's a terrible idea. Canada grows lots of timber. But if they need to buy rice.
If Canada needs to buy timber, like
we're all in
something's
trouble.
going-
We're all in trouble. They need to buy rice for people. Would they borrow money from other central banks?
Central banks interact with each other all the time.
Okay.
I would say that probably the most common way that they interact with each other, especially in times of stress, is actually through currency. To be honest, this might be like more nerdy than is really helpful for people, but if you think about like there's a big financial situation, a crisis or something scary that's unfolding, you might see folks flocking to safe haven assets. So people are saying, crap, I don't want to be in equities or bonds or risky assets anymore. I want to hold like gold and cash and what have you. Sometimes that demand for those assets can, you don't have all of the dollars in the world sitting on the ground somewhere, right? They're sort of rotating through the global financial system. And so central banks do often provide each other those liquidity lines in times of crisis so that everyone can keep the financial system moving. And it's usually on a like hourly basis. We're not talking about like, let me give you a 6-month loan to cover your shortage.
Yeah.
But they are there in those times of stress for each other in particular.
Interesting. Okay.
Interesting.
So you said that the central banks, and that answers the question, what is the Fed? The Fed is a central bank, which we now know. But you were saying that they would increase what is it called? A standard interest rate? You said something like that?
Their policy interest rate.
Policy. And what does that mean? What's a policy interest rate?
So in the case of the Fed, the policy interest rate is the federal funds rate. And this is the rate that banks can borrow from the Fed overnight. So it's like the shortest term interest rate you can have. Now you might say, why would a bank need to borrow from the Fed overnight? Yes. And again, this is like totally so nerdy, you would very rarely need to know it type of stuff. But banks actually borrow from the Fed overnight every night. And the reason that they do that is our global banking system right now works with what are called reserves, which you can just think about it as like the cash that banks have in the bucket in case anybody needs it. And there are rules about how much of those reserves you need to have at a given time. And if you think about the US or Canada, South Africa, like these are big countries. And so the way that individuals are taking money in and out of their banks, or companies are taking money in and out of their banks, you can imagine that probably you get to every night and you're like, I have a little extra, or I'm a little short of this number I need to have. And so the Fed is sort of sitting behind the banks being like, no problem, here's a little extra. Or sure, I'll take yours overnight and make sure that this other bank has it. This literally every night this is happening. And
like a balancing act all the time.
All the time. And so when you hear about like financial plumbing issues, you can rest assured that like the smartest people in the world have figured this out. So that's the policy rate. It is not the interest rate that you or I pay on anything.
Got it. So it's what the banks borrow at, and then the banks lend to you at an increased rate to that because they need to make money.
That's right. But it's not just because they need to make money, although that is obviously a part of it. A lot of it is like the time period that you're borrowing at is very different.
True.
So, and with no offense to any listener, you are probably not as strong of a borrower as like JP Morgan
Yes.
or Bank of America.
Yes.
I know that you recently did an episode on mortgages.
Yes.
And I think about this all the time. Nobody should lend money to me for 30 years. Like, if the government was not securing that loan, like, I have a job and I'm like doing my thing, but the likelihood that over 30 years that's not true is like really high.
Totally.
Yeah.
And so if you think about a bank and the Federal Reserve lending to each other overnight is like the most, as close to risk-free as you're going to get.
Totally.
Me, Bank A, lending to Company B for 5 years. That's a longer time. That company's probably got, some risk that their business would be impacted by something, disruptive over that 5 years. So I might charge more, yes, because I need to make money on that activity, but also because I'm taking the risk that that company won't be able to pay me back.
Okay, this is super helpful. So we go in, we're talking about inflation. Inflation is raising. So if the interest rates go up, so the Fed sets these interest rates, they go up hopefully 2% a year. Is that the idea? Or inflation hopefully goes up 2% a year. How does the interest rates that the Fed set affect the inflation rates?
So remember we talked about those two types of inflation.
Yes.
Demand pull and cost push inflation.
Yes.
If interest rates are higher, so the cost of money is higher, it's a little harder to invest in a new business activity, or it's a little harder to buy that thing that you wanted to buy. That just on the margin will make demand a little lower. And because often, not always, but often, one of the big challenges with inflation is that there's a lot of demand. Then by starting to curb demand on the margin, you start to ease that inflation pressure. That's the idea. And it's meant to work in reverse too, where if demand is a little sluggish, the economy's maybe slowing down, then by lowering interest rates, making it easier to obtain money, then you might have folks that say, well, now I can do that new business idea, or now I can make a different purchasing decision. So you hypothetically would be increasing demand in that case. So that tool that the central bank has, I said earlier, it's a blunt instrument. It can only really try to impact demand. So if you think about sort of all the different cost pressures that you could have on the economy, we talked about demand pull inflation, but also cost push inflation.
Yeah.
It's not always the case that raising interest rates makes your input prices go down, right? Like that, it doesn't help the cost push side of things, because if there's a supply chain issue or a trade war or let's say there's a shock to labor, like a big change in immigration policy or a big change in workers' preferences. And so you can't just wave your magic central bank wand and make those cost pressures go away. And it's one of the real conversations about central banking right now, which is to say, look, lowering interest rates in particular, that's what's happening right now in a lot of the world, might help to stimulate demand. But it's not going to do a whole lot to change these global supply chain, immigration, et cetera, challenges. And so is it the right tool?
Yeah.
Maybe or may not be, but it's the only tool that central banks have.
This is so interesting, especially in the state of today's global affairs, because the central bankers must be pulling their hair out, because every single day, all tariffs are changing, they're happening, they're not happening. Immigration is psychotic right now. You can come, you can't come. You can come if you have $1 million, you can't come. It's just so crazy. So they must be losing their minds.
I don't envy the job.
Yeah.
It is on my bucket list one day to tribute to public service in this way, but it's a really, really tough job because, again, you only have certain tools that you can use. Now, there's one thing that we skimmed over a little bit when it comes to like all the different central banks in the world that I think is kind of interesting on this point, which is that the Federal Reserve is unique among the major central banks. And that is because it focuses on two things: inflation and employment. Most central banks in the world only focus on inflation. So if you're sitting in Canada and inflation is high, but growth is bad, like that's not a great economic backdrop, right? That's a tricky situation. Let's say unemployment's at 10%, but inflation's at 5%. The central bank is supposed to focus on inflation. So they might be raising interest rates, even though a lot of people are out of work and things aren't looking very good. So they're hypothetically trying to make demand lower, even though the sort of real economic experience for a lot of people is not very good.
Got it.
Right.
The Fed has too. It would be worried. It would look at that balance and say, oof, inflation's 5%, but unemployment's 10%. Like maybe the unemployment piece is worse and we're actually going to lower interest rates. Like inflation might have to go higher in order to get people back to work and get sort of the economy moving. And that is exactly the situation that the Fed finds itself in today, though at very, very different levels.
Yeah.
The unemployment rate in the US is around 4%, which by all historical standards is like a great outcome. But we're in a situation where nobody's really hiring, nobody's really firing,
Yeah.
in part because of these global challenges.
Yeah.
And
Right.
inflation's at about 3%, a little higher than 2%, in part because of these global challenges. And so the Fed looks at that balance and says, well, they don't say this. I'm saying this on their behalf, but they're like, we don't know. We don't know. Like, it's not clear that lowering interest rates or raising interest rates will make either of these things better.
So much uncertainty. This is so helpful. It's
Yeah.
really starting to make sense. Because one of my questions when you were using the standing desk example of the reserve saying, oh, well, can't you just buy a cheaper desk? My question was, well, why don't they want everyone to want to buy a standing desk? Isn't that good for the economy? It's more expensive. Everyone gets a standing desk. But your point is that it sounds like their job is this like omnipresent balancing act where in relation to inflation, employment, and the global world order, they're either raising or lowering those rates to either make people be able to buy the standing desk or not, to like maintain that balancing act. Is that kind of
Exactly. In fact, like if I were showing you this on a PowerPoint slide, and I do use this PowerPoint slide all the time, I would literally show you a seesaw. Like,
yeah,
here are
yeah,
the pros and the cons of these decisions. And keep in mind, the standing desk is like only one thing that you have to buy to live your life, right? It's also groceries, it's housing, it's everything. And so that balance is so complicated.
Totally.
right?
And when it comes to the housing piece in particular, actually, no, when it comes to any of it, remember the interest rate that the Fed is setting is that overnight interest rate with the banks.
Yeah.
The interest rate that you're paying to buy your standing desk or to get a mortgage, those are
It's trickled
influenced
down.
by what the Fed is doing,
Right.
but the banks are setting those interest rates. And so it's, oh, what a tangled web we weave.
That's what it sounds like. But I think my takeaway from that is like the central banks, in theory, have everyone's best interest in heart in that everyone's like trying to like strike this harmony of people being employed and being able to buy what they need to live their lives to an extent. And that is just incredibly complicated to be able to strike. But like the takeaway is that they have our best interest at heart, even when it may not seem that way, because global politics and all these other influences are making our lives seem really hard. Is that fair to say, maybe?
That is fair. That is fair. At the end of the day, the central bankers are government employees, like trying to enact a public service. And so the goal is to make things as good as possible for as many people as possible. It's just lots of different
It's hard.
types of people need lots of different types of things. It's really hard.
So they're
Same.
setting these interest rates to hopefully affect inflation in the way that they want it to go, is I think the idea. Does inflation hurt different income groups in different ways?
Yes.
Okay.
Not everyone feels inflation equally.
Yeah.
And generally speaking, households with lower incomes spend more of their budget on essentials. And so inflation not only hits them harder because they're usually spending 100% of their paycheck on the goods they need day to day.
Yeah.
But also if you're spending more of your income on essentials and the prices of those essentials go up, then like you're not spending your money on anything else. And you might even, if inflation is moving higher, you might not even be able to buy all of your essentials. And so lower income folks feel inflation first, they feel it hardest. But there is a nuance to this, which is that inflation really at its core is about how much do we pay for stuff relative to our income. But inflation also impacts the financial markets. So, for example, if typically the financial markets react negatively to inflation moving higher, certainly to surprises in inflation. If that's the case, you might see stock prices move lower. You might see bond prices move lower because their interest rates move higher. You name it. So, let's say the market gets hit. So, if you are a wealthier person, or perhaps not high income, but have a lot of savings, and that savings is invested in the market, then you might be negatively impacted in two ways by inflation. The prices of stuff is still going up for you, and also your investment money, again, if the market reacts that way, is worth less. The folks that are the most negatively impacted by inflation are usually those that are on a fixed income in retirement, because they get impacted negatively by both. Their money is, let's say, sitting in bonds, churning out a little bit of income, and inflation not only makes their cost of living higher and they can't raise their income, but also impacts how that money was invested. And so the short answer is just the less you have, the harder inflation bites, sort of bar none.
Okay, that's actually one, very interesting, but two, I think a good segue to one of my questions around how does inflation affect investing? Because we did a really great episode with Cam Rogers, who actually Anna introduced us to as well. She is so great with her connections for us. But we looked at how do you invest your first 5K? So we had a lot of people who had money, just cash in the bank. They had never invested anything, and they said, can you help us figure out what to do? So how does inflation then affect your investments and your portfolio? If we have stocks and bonds, stocks ownership, bonds lending, how does it affect it?
So you might also have cash.
Yeah.
So we'll start there.
Yep.
Like, as inflation moves higher, the value of your cash moves lower, right? The purchasing power of your cash moves lower. That can of beans that was $1, it's now $1.02 or $1.05 or whatever. Might not seem like a huge difference, but if you're saving for retirement in particular, then you might be concerned about that can of beans costing $17 in the future. And so you need that cash to work for you, right?
Yeah.
This is why most financial professionals would tell you, like, you should, if you're young in particular, and by young, I mean like under 50, like if you have time till retirement, you should probably be invested. You want your money to work for you. Even if you're invested in like very air quotes, safe, relatively safe assets, then at least you want to keep up with that cost of inflation. Again, that's the conventional wisdom.
Just quickly, before you jump into that, what qualifies a safe asset?
Great question. Typically, a safe asset is one that has the least volatility when the market moves.
Okay.
So let's say the stock market drops by 10%. Does your asset drop by 10%? The stock market is, hundreds of stocks.
Yeah.
Do you have the ones that drop 10%?
Yeah.
Or do you have something else? Maybe it's a bond or a home or cash, what have you, that didn't drop 10%. That's the thing about cash, is that it's not going to grow on its own to keep up with inflation, but it's also not going to lose value when the stock market goes crazy or something goes wrong, right? And so one of the things that we've seen lately, and by lately I mean over the last 5 years, is we've seen a lot of people holding cash. But by cash, what I really mean is they have a high yield savings account, or they're invested in government bonds, which are perceived as quite safe, because both of those things will get you a little bit of interest or yield on your cash. You'll make a little bit of money by sitting in them. So I've moved from the safest, which is like cash, to cash-like, which are those air quotes like hyper safe bonds, or sort of government securities. Then the sort of next most safe thing historically has been other types of bonds. So corporate bonds, for example. And the reason those are perceived as more or less safe, but let's say that you choose a company to invest in a company that has a good credit rating. You're not worried about it going bankrupt over the 5 years that you hold the bond. The price of that bond can go up and down. But if you just hold it till it matures, you didn't lose any money. And not only did you not lose any money, but one of the nice things about bonds is that they typically pay a coupon. And you used to literally have like a piece of paper, like when you see like a telephone pole that has a piece of paper taped to it that's like, if you need a cat sitter, call this number. And you like tear the piece of paper off with the phone number. You used to do that. You used to have a literal paper bond and you would tear off the coupon and take it and be like, can I have my 5%? That still happens figuratively. They just don't have the paper anymore. Although I really like to think of like sitting in my room, cutting my coupons and being like, yay, I made money. So if you hold a bond, if you're not trading it, you invest in a company and you hold it till it matures. You've lent them money. That company said, I need $100, Lauren, to do my activity. And I say, I think that activity sounds good. I'm going to give you $100. And they say, great. Every 3 months for the next 5 years, I'm going to give you $3 to say thank you for lending to me. And then in 5 years, I'll pay you back. So those tend to be, again, pretty safe. And then we all know stocks or equities are volatile, tend to have higher return over time because you're being compensated for taking that higher risk. When it comes to inflation, though, typically the sort of like easy way to think about it is that if the inflation rate moving forward is actually going to be closer to 3 or 4% rather than 2%, you might want to invest your money such that you gain that extra couple of percent back. So maybe you want to take on more risk, let's say, on average. But there's another way to think about it, which is that you can think about investments that are inflation aware, let's say. There are types of assets whose cash flow or the yield that they churn back to you are linked to inflation. And those are usually things like real estate, where let's say, if you had an apartment and you're renting it out to someone, you could increase the rent every year. You see what I mean? Like the asset itself can keep up with inflation.
Right.
Those tend to be not necessarily riskier than stocks, but they tend to be, let's call it mid to high risk because you get that money to compensate you for the risk. But when we think about sort of investing for inflation, we try to not only think about higher return, because that's not appropriate for everybody, that higher risk, but like what are the types of assets that are linked to inflation in a way that's productive for that person?
Makes sense.
Okay.
Interesting.
That is super clear. So as we operate in this wonderful economy and we hear the words inflation happening, what should we be thinking and doing? And then what should we stop doing when we hear inflation's coming or is happening?
Take this on two levels. I think the first is like, no one knows inflation is already here better than women, right? Like you see it in the things that you're buying day to day. You see it in the way that you sort of care for your family. You see it in your finances, et cetera. So don't panic, right? For example, in the last 5 years, we've gone through the worst inflation shock in 30 years. And we were talking about it in an introductory way at the beginning of this podcast, right? Like, you'll probably be okay. Is what I'm trying to say. So don't panic. I would say in that context, it's unusual that a macro factor like this, macroeconomic factor like inflation, is something where you'd want to go like drastically change your life. One of the things that I think about a lot when people ask like, oof, if inflation and interest rates are moving higher, should I buy a home? Buying a home is a big financial decision, but it's also about way more than just the finances, right? And you've talked all about that in a recent episode, so I won't dig into it. But your investments, your financial situation should probably be built for a couple of inflation shocks in our lifetime, right? Like you should probably have a mix of stocks, bonds, maybe some alternative assets, et cetera, just to build resilience against these things that we can't control and don't know will happen. So that's what I would call the general advice, which is like, for most people, don't worry about it too much. For those like really interested gals who are like, no, like tell me my 3 trades, tell me what we actually do. I'll say this. The last 20 years, 30 years, we have been in an environment that is very much disinflationary. Globalization, by and large, made it so that we could buy a lot of things without seeing a ton of inflation for a really long time. In fact, the period from the financial crisis to COVID, like 2010 to 2020, basically, almost no inflation at all. Looking forward, I'm not confident that's what we're going to get, right? Like, it's not that the world is deglobalizing so quickly, but we are starting to sort of like re-globalize and reshuffle in a way that I would expect supply chain issues and some of these government sort of tussles, et cetera, like they're probably going to continue. And that's not, I don't mean that in a dramatic way. It's just like, look, like what we've had, we're probably going to keep having for a while, right? And so your portfolio over the last 10 years probably had a lot of US growth equity.
Yeah.
Like the stock market's gone up 10 to 30% a year for the last 15 years. Your portfolio has probably drifted. And so thinking about that inflation awareness and saying, look, okay, in addition to stocks and bonds, I probably want a little bit of gold, a little bit of real estate, maybe a little bit of these types of things. Makes sense. Maybe in your stocks, for example, you want to look for some of those securities that pay dividends because that gives you a little bit of cash every quarter in addition to whatever price appreciation. And you're looking for that inflation resilience. I could go on and on.
Yeah.
But the TLDR is like good time to talk to your financial professional and just be like, look, do I have any inflation awareness here? Because again, I think that 3-ish% is probably where we're going to be with some ups and downs, more than 2%.
Yeah.
And if you need to pay those healthcare bills when you're 80, got to be ready.
Gotta be ready.
Right.
Okay.
Totally. Inflation awareness.
Yes.
That
I
is a
love that.
good takeaway term.
Yes.
Inflation awareness.
I have 2 more questions. One is probably a little bit nerdy in it, but what are you most excited about in the economy right now?
Actually, we were just talking about it.
Okay, great.
Like I'll answer this with kind of an anecdote. So I was starting my career I was doing foreign exchange and interest rates work at a big bank, investment bank, when the financial crisis was happening. And I remember sitting there being like, crap. And not crap, I'm going to lose my job, but crap. Like, I'm going to be studying this for the rest of my career. Like, the most important thing that will happen in my entire working life is happening in the first couple of years of that working life. And that's lame.
And School of Hard Knocks. Talk about the School of Hard Knocks, honestly, coming up during that.
And look, those like 5-6 years that followed were very, very rough for employment, for, just being in the industry. But it has never gotten less interesting since then. And so as I think about just like being an economist, especially an economist that works in asset management, like this is nerd heaven. It's nerd heaven, but it's also, there's a real turning point happening in the global economy right now that makes conversations like the one we're having today so important. Because people probably do need to save a little differently than they have before. People probably do need to invest a little bit differently than they have before. You've spoken a lot about it in previous episodes, but we as a generation or generations are going to have a very different lived experience than the 2 or 3 above us. And that makes the type of questions like, does inflation hit different people differently? It makes them so important. And so if I were to say, what am I excited about? It's that the world order is shifting under our feet. And that makes these questions so exciting. It makes their answers unknowable. And so it's like, it's nerd heaven. Heaven for nerds.
I love it.
Your take on it and your ability to explain this in ways that the everyday people can understand is so incredibly important. Because for our generation who just now, Caitlin said, are just even starting to think about investing, or 10 years above us maybe have been investing for 5-10 years during this maybe golden age of the S&P 500, things are shifting. And so these conversations are so important, but people who can explain it in such a way, actual experts who can explain it in such a way, that's why we need you guys. So I'm loving this. Continue.
Well, before I ask this question, Lundie, do you have any quick ones you want to jump in? Nope.
No, that was really going to be mine, was like, what's going on today that we should be aware of, that we should all be thinking about. So you nailed it.
So then my last one is what we ask every single expert as our last question is, what should every woman know specifically about inflation and the Fed, and take away?
I'm going to cheat and answer it 2 ways.
Yeah.
Because because I'm a cheater. That's why. So one, thing that I would love people to walk away with, just knowing, is that like I am a professional economist and investor. I also do a lot of public speaking, like a lot of TV, a lot of whatever. When I got married and my husband and I were looking for a financial professional just to help us navigate these conversations, like I have the knowledge, but my relationship doesn't have the knowledge. You know what I mean?
Yep.
We interviewed 10 hours, 1 hour interviews with financial professionals before someone addressed me. So if you are listening to this and you're like, you know what? You said I should be talking to a financial professional about how I inflation aware my portfolio, and you go and talk to someone, you get like a spidey sense that like they're not listening to you, then they're not. Right? Like if they weren't listening to me, they probably weren't listening to you. So like really listen to your gut. Like you know what you need. You know what you need. And so when it comes to the Fed and inflation, et cetera, like part of what my honest reaction to what you asked, Caitlin, was for a lot of people, this just doesn't matter that much. You know, like it's really, really important in the plumbing of the economy. And it does, you know, it impacts politics, it impacts policy. It's not that it doesn't matter, but in our day-to-day lives, like you probably don't need to change a whole lot.
Yep.
Don't overextend your budget. Make sure you have an investment plan, stick to it. And if your investment plan was based on the last 15 years, maybe make some tweaks to make sure that you're sort of prepared for how the next 15 years might look different. The end.
Yep.
I hate to say that like what I do probably shouldn't influence people's decisions on a day-to-day basis, but that's probably the truth.
But that is so great. And I think the one thing I'll say to that is fantastic, but it's also great to know that. So it's good to know what inflation is, how it potentially could affect you, and to also have the confidence that things are okay. I will be okay. But in order to have that confidence, you need to understand it. And that's why this episode has been so freaking amazing. Lauren, thank you so much.
Thank you for having me.
Thank
Lauren,
you so
this
much.
has been incredible.
Will you tell Caitlin and then tell me what you get at the gift exchange tonight?
Yes. Yeah.
I will. I can't wait to report back.
Yes,
I will.
I'll send you.
Everyone gets each other poppers.
Welcome to the debrief, where we discuss things we needed a little more clarity on.
Okay. Inflation.
Inflation. With
Thanks
Lauren.
What a queen.
I texted her when I was editing this, and I was like, you should, in the chapter of your life, be a professor, because if my economics professor in first year explained things to me the way that Lauren was explaining, I would 100% have kept taking economics, because she does such a good job of it, but also makes it very relevant and very fun and interesting in a way that economics so often is not.
Totally. She made it so exactly relevant to what my actual life looks like. It made it like very tangible and very easy to understand. So I know how lucky we're to have her. And in our trailer, which Caitlin cut, I realized, I mean, I knew she did public speaking, that she was called into like
The
major news, but she's the real deal. So we were very lucky.
Literally, I had so many to choose from. She's on the news every single week. It's so crazy.
And especially, I can only imagine now. Yeah, she's like,
I know. And it was interesting also because, well, this works because it's coming out as the following episode, but we are interviewing an expert on political polarization. And I feel like so much of what we spoke about with Lauren kind of feeds into that, of just like geopolitics and the macro global economics of it all, which was that's actually my first takeaway, and maybe my biggest one, was that politicians spend so much time telling citizens that the reason why the economy is so bad or your eggs are so expensive is because of mistakes the last administration made. But the reality is, it's so global, it's so macro. The economy is not just tied to like the few decisions that one administration makes, like whether it's COVID and infrastructure of moving whatever, like your clothes from China all the way to the US, all these different things increase the cost of living it is not just tied to one administration. So it just really made me pause to think that before we jump the gun and we just blame everything on one group of people who do have influence, obviously have influence,
Right.
we need to do our own research and really do a better job of understanding just what's happening in the world and how that plays a role in affecting our day-to-day lives. I guess it is good to have a tap on what's going on before you just like follow whatever's being said by whatever administration's in power at that time.
Yeah, I agree. It's just about being informed. And
Totally.
I think so many of these things seem so like over your head. And so it's like, I'm not
Totally.
even going to try. But if you have this baseline understanding, like, I didn't know that
Same
people
thing.
who work at, thank you, the central bank, which is the Fed in the US,
Yes.
are civil servants. I didn't know that they were government
Me neither.
employees and that their job is to just try to like balance the seesaw, like she said. Like there's like essentially this seesaw, which I can imagine right now is like way out of frickin' whack. And
It's a
their
roller
job,
coaster right now versus a
yeah.
seesaw.
And people
Yeah.
are just, or the Fed is just trying to like balance it out, which is crazy. And I didn't realize their primary goal is to hopefully make it easy for the general public to be able to buy what they need and go to work and support
Their
their
lives.
families.
Yeah.
And like live their lives. But there's just so many factors at play that don't make it as easy as that. And I didn't know that. And that's crazy.
And they don't set the inflation rates, they set the interest rates, which affects inflation. So that's good to know.
Correct. Yeah, exactly. And then mortgage rates and all the like are impacted. It's like a whole trickle down, like tangled web.
Yeah.
But my other takeaway, which I appreciated, was that the average person, outside of, she gave some really practical advice around like, yes, maybe take a look at your investments or your different types of assets and diversification so that you are inflation aware. I like that. The new term, which I actually did take to my wealth advisor. I said, is my portfolio inflation aware? And he was like,
well done.
Good question. I think he was like, wow. Wow. Lundie read a book.
Lundie's been doing her
like, yes. And he actually took me through my exposure to US versus global and like how that actually is supposedly inflation aware. So learn that. But outside of those like practical steps, she was like, for the most part, you don't really have to worry about it. It's not something to like spiral over because it's a fact of life. And she's like, you're going to live through multiple financial shocks in your lifetime because that's just the way it goes. So you may as well like prepare as much as possible, be informed, but like ride the wave basically.
So yeah, it actually was really good timing because one of my friends texted me and said was really stressed about what's going on in the Middle East and how people are saying that price of oil is going to go up and that some of the like biggest transit routes are being blocked right now because of the war. And she was like, what are you and Steven doing about your portfolio and your money? And I was like, just post my inflation episode, just leave it in where it is. And we are super young. We can take the hits right now. It's gonna hopefully be okay.
Yeah. Maybe buy a little gold. Like everyone keeps saying buy gold. I'm like, where do I buy gold? I don't know.
Lundie's like, perfect excuse to go to the jewelry shop. Here I go. Gold choker for me.
No.
You could buy it on your you can buy gold on like you would buy a stock.
Like go onto your like Vanguard, just buy gold.
Exactly, Vanguard, Wealthsimple, whatever, where you buy and it's like you buy like a fractional amount the way that you would that you would buy like a stock. Yeah, you can do it on there.
Well, I haven't done that, so anyway.
That's okay. I'm sure your wealth advisor has you covered.
Oh, yeah.
I'm pretty sure every wealth advisor has gold in their portfolio because it's just like the de facto currency when things go wrong, which is really nice for people who work in the gold industry right now. It's really pumping.
When I was home, this is a complete aside, but while I was home, I went thrift shopping with my mom and I bought 2 beautiful silver candlestick holders and they were marked as like 60 for the pair. And I bought them. And the guy was like, in the last week that these have been on the floor, I think they've doubled in value. Like this is probably $150 worth of silver, but Amazing. It's marked as 60. And I was like, well, thank you, sir.
I will take them.
You're like,
They are-
I'm adding to my inflation aware portfolio.
Yes.
This is my hard metals. Yeah. To like put it in the vault.
Correct. Precious metals. Candlestick.
Yeah, exactly. Coated in
Exactly.
wax. It's gonna be like a down market, and Lundie goes to like the man on the corner is like, how much can I get for these? They're
But all
coated
of a
in
sudden you
wax.
see me, I'm like decked out in like just gold bars, like inflation awareness. Honestly.
I would love it. But yeah, I mean, for me, Lauren was just like, we did this episode before the Christmas break or holiday break. And I said to Lundie that we need to open with this episode because Lauren was just so good at what she does because it's her job and she's an actual expert. And you know what? We love it.
And we love it. So shout out to Lauren.
Thank you.
Thank you for joining us. And we hope you learned something. We'll see you. I keep saying it's typical to say we'll see you next week. We
Yeah.
are trying out a 2-week cadence actually with this season, just because we are busy as fuck. So we will see you in 2 weeks.
2 weeks.
And tell us how that makes you feel if you're listening. All right.
Lots of love.